Good morning, it's Harvey Jackson. Just going to get to a couple of the news items that caught my eye. The war is on and off in Israel, but let's just talk about Canada. Um, so Canada losing its position as a G7, basically in financial, basically looking at a G11 position that TableSalt put out. Now, here in this article put out by RBC, they're talking about, and I'm going to just highlight this area here. Canada is emerging from an unprecedented capital recession. The renewed interest comes from a decade of weak business investment, stalling productivity, and staggering living standards between 2015 and 2024. More than $1 trillion of investment exited Canada, the largest capital exodus in Canadian history. For every dollar of inward FDI, $2 exited. And then they talk about a little bit of a woke shit there, but whatever. You have to forgive them. They're one of the national banks, and they got to speak French as well as English. So otherwise, they can get fired, I'm sure. Yeah. So this is the just the exodus here. You can see, the downward slide of investment net. So just a graphic that shows here. Here's just another excerpt of the Synovus talking about investment and how it can't invest.
Of the Canadian oil sands company Synovus told analysts on a quarterly update call Wednesday, federal regulations in their current form have driven investors away.
For example, the industrial carbon tax is unique to Canada. No other major oil-producing nation in the world has one. The result is this tax does not incent decarbonization of the Canadian industry, but instead incents industry to invest outside of Canada.
I think if Ottawa and our government here knew there was a war coming, they might have framed the MOU a different way.
It's why this energy industry expert believes it could make sense for the federal government to deprioritize climate issues for now.
This war is going to end at some point, and governments will continue to look at climate, among other issues like energy security and affordability, and decide, how they intend to meet their climate commitments.
Well,
yeah, no other country in I think there was a YouTube with Pamela Wallen there talking about no other country is going to meet the Paris agreements, but Canada still wants to for some damn reason. I don't know why, but anyway. So what is China's anti-sanctions law and how does it work? Here's just a little bit of what China's position is. And
are built on oil. Beijing is Tehran's largest trading partner and biggest buyer of its crude, which gives the country a financial lifeline, despite U.S. sanctions. China bought more than 80% of Iran's shipped crude in 2025. Here is how it works. Much of it goes to smaller, independent refineries known as teapot refineries. They are more willing to take on the risk of processing sanctioned crude, which is often bought at a discount. But disruptions in the Strait of Hormuz have reduced energy flows. And for China, that's a problem because it relies heavily on exports through this route. And that's not all. Last month, the U.S. sanctioned several Chinese refineries for buying Iranian crude worth billions of dollars. These are some of them. Essentially, trying to cut off one of Tehran's main sources of income. But Beijing is pushing back. It's blocked these U.S. sanctions, and it's telling its companies not to comply. China says it's a neutral party in the war and does not want to get involved. But it has also absorbed the shocks caused by the restrictions in the Strait of Hormuz, and it has repeatedly called for a ceasefire and freedom of navigation in the waterway.
World food prices rise to more than 3-year high in April. So Iran war, Strait of Hormuz closure, boosting vegetable oil prices. You can see war, energy, price spikes, raising demand for biofuels, and cereal prices relatively resilient thanks to ample stocks. So I'm going to go back to the article I talked about maybe a couple of weeks ago. And this all is all in good, but when it comes down to how the food products at the grocery store only account of 5.8 cents of every dollar spent. So do you think the front end here is a big deal when it comes to our prices of our products? Everybody else gets on the back and still makes up that 94.2 cents of every dollar. So yeah, a little bit of money made by the farmer is not going to make up a whole lot here. So they can blame all they want here. Bushel Plus just put out this, and I thought it was just a different way to look at the graphic. And again, the problem is it's March 31st, and the delay in time just is unbelievable, right, when you look at it. But it does give us a snapshot of what's left. There's a fair bit of wheat left, little less canola, but still a fair bit of canola left as of March 31st. Barley and soybeans basically have left. Here's the graphic, just with this, the Canadian Grain Commission to the date, to last week's date. But you can see here that there's still a fair bit of wheat, still 34% of the durum that was grown last year, and canola as well, 33% left. Quick look at the weather. So here's the drought monitor map. There is drought there and there as well. And it looks like the planting pace is just going on, but you can see red winter wheat. It moved back up from 69 drought to 70% drought. So, but the key areas I'm looking at for red winter wheat is here and Washington State kind of area. And here's your severe and medium term drought. Just intensifying. Planting pace is medium range on the corn and to the upper end on the soybeans. So the market is pricing in as if there's no drought, and there is drought, but the planting pace is going along just with no issues, it seems. So a quick look at the market. Canola is just slightly up, 80 cents on July, and on November only 20 cents a ton at 7.43. Soybean oil is up 0.4 of a cent at 74.56. Crude oil all over the place, all over the map yesterday and today, even $94.59. And the diesel fuel is basically flat at 3.81. Soybeans flat at 11.92. Spring wheat up a couple pennies at 6.75 on the July, and on the December it's 7.15. And your Kansas is up 2.5 cents, and your Canadian dollar basically just tracking slightly down. So a quick look at the charts. We've been hit that target level and retrace basically from there. Looks like we're up against some of the shorter and longer term moving averages here now. Same thing on the November contract as well. 2 days ago, big drop, but still holding in this area of the higher end here. But still giving us the sell signal on the slow stochastics, along with the European rapeseed and your soybean oil as well. Soybeans back into this channeled range that we were trading in for quite some time. And even your new crop actually got into this channel as well now. Here's your crude oil. 2 days ago, big drop. Still dropped some more yesterday, but it's just a wide range of trade. Brent, here's your diesel fuel futures, still looking to drop back into this lower end of that range for sure. Gasoline futures, top end here, but we're trading right at the 10-day moving average of gasoline prices right now. Here's your Canadian dollar. You can see that we're making lower highs. Now, is that going to push us down? I'm hoping, but this mid-range of 73 cents, 73.5 cents area is pretty sticky, it seems, at the moment. US dollar, your S&P, the market just loves this. The US market is definitely taking some gains from what's going on lately anyway. So quick look at wheat, the slide, and looks like we're just holding here. So we're currently trading just below the $7 mark on the November, or on the July contract, and on the December contract at 7.15, slightly green today. Here's your Kansas, drop yesterday, now holding at the 20-day moving average. Same thing with the December contract. And yet here we are with the Chicago. We broke that trend line and now trading below it, but right at that 20-day moving average as well. Here's your milling wheat and your corn.